Given social inflation and inflationary economic pressures, key questions in the directors and officers insurance market appear to be how sustainable their recent, more favorable results will be in 2023 and beyond. Here to discuss a new report on the line of business is David Blades, Associate Director, Industry Research and Analytics, and Christopher Graham, Senior Industry Analyst, both with AM Best. David, D&O premium just absolutely exploded in 2020 and 2021, but kind of leveled out last year. What's driving that?
Well, like you mentioned, John, insurers had gotten to a point where they really felt the need for aggressive rate and price actions based on the results that they dealt with for most of the last decade. And so what we saw is in 2019, and then definitely, as you said, through 2020 and 2021, rate increases had gotten to double-digit level and even some mid-double-digit level, 30, 40, even 50% rate increases that they were applying to their renewals. What we saw last year was that at the start of the year, those rate increases started to basically plateaued, and then by the end of the year, companies, particularly you saw in public D&O, where renewals were coming in at maybe single digits or even some flat renewals based on the individual risk characteristics of the different account. And I think that's where we saw the reflection that companies really had felt based on the aggressive price increases that they'd received in those 2 previous years, that they'd gotten to a point looking at their overall portfolios that they really felt that they were in a good position. And I think that's what we saw help drive down the overall premium level last year, especially when you compare what we were seeing on renewal basis quarter to quarter from 2020 and 2021. In addition, IPOs had played a big part in terms of growing premiums for D&O risks. We saw a huge decrease in terms of the number of IPOs in 2022. Compared to 2021, you saw the total of IPOs go from 968 to I think 110 in 2022, and that also had a big impact on the D&O premium, because like I said, in the previous years, particularly spurred on by the IPOs and the economic environment that was really favorable for IPOs, and particularly through special purpose acquisition companies, SPACs, we'd seen that be a driver, and from that perspective, but that kind of started to turn the other way in 2022. And so that also, with, like I said, the difference in a pricing approach had a big impact on premiums that we saw by the end of last year.
You mentioned the rate increases. Do you think insurers are just doing a better job setting rates given the complexity of that line of business?
So I think companies definitely, as they took a step back, like I said, looked at what they were looking at in their portfolios and what they had learned over the last decade, and specifically what they were learning as they really were trying to address individual issues. Companies put a lot of resources into understanding what were driving the loss trends and the lack of profitability in their D&O books. I think they put a lot of resources into making sure that their claim and legal disciplines were communicating with their underwriters to make sure that they were making the best underwriting and pricing decisions going forward. And I think that manifested, I think, in better decision making, and it got them, again, looking at their portfolio on an individual risk basis. I think that got them to a point where they felt better in terms of how they were underwriting it. And I think that knowledge was also being shared with their product designers in terms of how they were tweaking maybe new products that were coming out to deal with some of the emerging and evolving issues that are impacting D&O insurance. So I do think companies, to answer your question, I do think companies have done a better job and have put more resources into that. The one thing I'll say to counter that is that a lot of the factors come through, when cases work their way through the juries or into settlement. Obviously, the post-pandemic backlog of cases, I think that plays a part in terms of possibly in some of the trends that may have been a little bit more mild. I think as those cases start to work their way through the court system, we may see other trends emerging that may not be as favorable that companies then have to react to. So, there is a thought that maybe some of the pricing actions where companies start to be more aggressive due in part to competition. Whether that's going to play out and whether that will, show in when we look at results in another year or two, whether some of the pricing actions and the tempering of rate increases may have been a little bit premature. That'll play out, and that's something that we'll continue to look at.
I want to talk a little bit more about that in a minute, but before we do, Chris, are we seeing new entrants in this market, and is D&O something that we regularly see new entrants in?
So, yeah, in 2022, at least through September, we had 21 new markets compared to 2021, and 38 new markets compared to the premium boom that started in 2020. So we've got 38 new markets compared to 2019. Typical for the property casualty insurance industry, right? If one area is not working, these are 12-month contracts usually. So, the insurer is going to move their capital to where they see they can make money. And, that extra capacity is also playing on the pricing that we're seeing now too. More capacity, more competition, prices go down.
So David mentioned the court closures. That's pretty much behind us right now. But how will that affect things as things are opening back up in the courts?
Well, there's still quite a backlog. The courts might be open, but you've had, how many months or, even, over a year, pushing 2 of cases that, got put on hold. So that's going to take a while to unwind. So you're still going to have a backlog for the foreseeable future. The one area that might start pushing some more cases through quickly is a lower number of claims. If we saw the big drop in IPOs, well, there's an area of claims that aren't going to be as prevalent, at least in number, going forward. So that might take some of the pressure off the courts, but there's still quite a bit of time in which they have to catch up.
So where are we seeing a decrease in claims and filings?
Oh, it's a lot of the decrease in claims is in the securities type of litigation. We're down a good almost 50% in 2022 from where we peaked in 2017, 18, 19 there. So we're seeing a big decrease there, and it's happening not just at the federal level, but even in state courts. There have been a big drop. There was a boon in state courts after the Cyan decision back in 2018, but after the Shabakuki decision in 2020, we've seen much less in state courts now.
Chris, David, thank you so much for taking the time to speak with us today.
Thank you.
Thank you, John.
That was David Blades, Associate Director, Industry Research and Analytics, and Christopher Graham, Senior Industry Analyst, both of AM Best. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.